It's Friday, the 13th of August 2021. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Sean Aylmer. Telstra promises to at least maintain its dividend to its 1.1 million shareholders as the telco giant reports its first jump in profit for 5 years. That's our main story. Also coming up in today's podcast, AMP shareholders finally get some good news. Well, just a little. Crown Resorts concedes it may have to lease its gaming licence to a competitor, and Canberra goes into lockdown. Then, after the podcast, stay listening for my chat to Care Super CEO Julie Lander about activity in the super sector. But first, here's a brief look at markets. Healthcare and technology stocks led gains on Wall Street overnight, though energy and materials stocks were lower. In early afternoon trading, the S&P 500 was up 0.2%, the Dow Jones Industrial Average was 0.1% lower, and the Nasdaq 100 was 0.3% higher. The S&P 500 is now trading at double the level of its bottom in March 2020. That is a huge jump in less than 18 months. European markets were mixed. London's FTSE finished 0.4% lower, while the Stoxx Europe 600 closed up just a touch. The S&P ASX 200 finished up very slightly yesterday, just 4 points, to hit a new closing record of 7,588 points. Among the large caps, the Commonwealth Bank was down more than 2% after Wednesday's earnings announcement. Cloud Accounting Group Xero was off 2.5%. On the other side of the ledger, Macquarie Group jumped nearly 2%. Wesfarmers had a good day, up 1.5%, while Woolworths was up 1%. Oil prices were down a touch overnight. The price of gold was pretty much unchanged, around $1,750 an ounce, and the Aussie dollar is trading at 73.4 US cents. Telstra has announced its first increase in net profit in 5 years, even though revenue fell 10% and pre-tax earnings were down 14%. The country's 11th largest company yesterday announced a net profit of $1.9 billion for the last financial year, and its share price jumped 3.5% after Chief Executive Andy Penn said the company had reached a turning point following 10 years of disruption due to the rollout of the NBN. He said Telstra will also spend $1.35 billion over the next 12 months buying back shares. Mr. Penn said one of his goals now was to maintain and potentially increase dividends. More than any other company, dividends matter at Telstra because it's got a huge number of retail shareholders, about 1.1 million, and many of them are in the retirement phase of life and rely on the income stream from the payouts. The steady stream of dividends, even through the COVID crisis, has helped offset concerns about the group's share price, which is up just 3% in the past year compared to the ASX 200's increase of around 25%. The group's dividend yield is around 4%, and that's pretty good. The giant telco is coming to the finish of its 5-year transformation plan. By the end, Mr. Penn will have cut the number of products from 1,800 to just 20, reduced its workforce by 25,000 people, and cut costs by $2.3 billion, while hiring 1,500 cyber experts. He said the mobile, consumer and small business segments of the group were healthy, while Telstra's 5G network now covered 75% of the population. Mr. Penn expected further growth from its 35% interest in Foxtel, as well as Telstra Health, Telstra Ventures, and Telstra Energy. So how is Telstra going? The jury really is still out. Undoubtedly, the turnaround strategy from Mr. Penn has had some great results, but there was, and remains, plenty to do to make it a strong competitor in an increasingly nimble technology and communications world. Telstra's share price is about where it was 4 years ago. Shareholders will be hoping for much, much more. In a moment, the rest of the news you need to know this morning. In overseas news, China has released a 5-year plan which will strengthen Beijing's control over strategic sectors including technology and healthcare. The Communist Party's Central Committee said it would expand government legislation and build a modern regulatory environment to meet people's ever-growing demands for a good life. Bushfires, winter storms in the United States and tornadoes in Europe have contributed to the global insurance industry losing $40 billion in the first 6 months of this year. It's the worst start to a year for natural catastrophe insurance in a decade. The stage is set for a record loss for the full year, according to industry giant Swiss Re. And a top Federal Reserve official has told the Financial Times that the central bank could begin dialing back its pandemic levels of monetary support for the US economy by the end of the year, given the strength in the economic rebound. President of the San Francisco Fed, Mary Daly, said the recovery in household and business activity would continue to gather momentum as people return to work. Locally, not many companies have had a tougher run than AMP, but yesterday it provided some good news. Underlying earnings rose by 57% last financial year. Net profit fell after AMP sold assets during the year. New Chief Executive Alexis George, who's only a week into the job, said she will cut superannuation fees, simplify the business, and work to keep money in the group's funds management arm as she tries to reinvigorate the once iconic company. The funds management business, AMP Capital, is due to be spun off, but has struggled to retain mandates with $6.7 billion flowing from the division during the 6 months to June. Around half of that was due to the loss of a property fund, which switched to rival Dexus. What to say about AMP? Alongside Rio Tinto, AMP had a horror 2021 in terms of public relations, but at least Rio had soaring iron ore prices to fall back on. AMP's share price, which rose more than 3% yesterday, is close to record lows and about 20% of what it was 3.5 years ago. Ms. George has her work cut out. The other big insurer to report yesterday was QBE, and it more than doubled its dividend for the 6 months to the end of June after announcing a profit of $441 million. That was much better than the $712 million loss last financial year. Its share price jumped more than 8% yesterday. Crown Resorts has conceded it will have to hand over the casino portion of its South Bank complex to a rival operator if ordered by the Victorian government, according to a report in the Financial Review. In its final written submission to the state's Royal Commission into Crown, the gaming giant acknowledged that if it lost its licence, it could be forced to sublease the casino site under the terms of its 99-year lease. Commissioner Ray Finkelstein has raised the option of Crown losing its licence several times during the course of the inquiry. He's expected to provide a final report to the Victorian government in October. New South Wales extended the stricter mask and mobility rules to more areas of Sydney yesterday after 345 new cases of COVID and 2 deaths were announced. Again, there were many people in the community while infectious, and 44 cases were detected in children. The ACT went into a snap 7-day lockdown last night after a single case was detected, although 3 of the man's close contacts also tested positive yesterday afternoon. The source of that infection is unknown. In Victoria, there were 23 new COVID cases, including 2 women who illegally flew in on a Qantas flight from Sydney to Melbourne. The Victorian state and federal governments have agreed to a new business support package for the state worth $367 million. Meanwhile, the Financial Review is reporting this morning that the federal government has upped its efforts to secure excess supplies of Pfizer and other vaccines. The media outlet is also saying that state premiers will confront New South Wales's Gladys Berejiklian at the National Cabinet today about her plans to open up her state even before 70% vaccination is reached. And the Fair Work Ombudsman last night opened the way for employers to mandate vaccinations of workers in businesses operating in hotspots. AGL Energy, which will split in 2 in coming months, has called for a coordinated long-term plan to shut down coal-fired power stations so as to avoid price shocks and blackouts for consumers. CEO Graham Hunt said a specific framework was needed to transition the economy. The comments came after he warned that AGL's core earnings would fall more than expected this financial year, and that was after posting a $2.1 billion loss for the 2021 financial year. The group had already flagged $2.7 billion in write-downs, and its share price fell 5.5% on the outlook statement. It's been a shocker for the energy giant. Low prices for its product, out-of-the-money contracts signed years ago, impairments on power and gas plants, a CEO who designed a demerger between its coal-fired power plants and its other assets, and he suddenly resigned. Surely things can only go up from here. Surely. National Australia Bank provided a June quarter update yesterday. It showed that cash earnings are up 13% from a year earlier thanks to much better credit conditions, but compared to the previous couple of quarters, earnings were flat. NAB share price closed up slightly yesterday. Rio Tinto traded ex-dividend yesterday, finishing down nearly 7%. 2 weeks ago, Rio announced huge special and interim dividends totaling $7.60 a share. Anyone buying shares on Wednesday gets the dividend, but not if they bought shares yesterday or today or tomorrow, hence the drop in its share price. Goodman Group is the country's largest listed property business, and it's done particularly well relative to its peers during the pandemic. That's because many of its assets are industrial estates, and those big warehouses were in strong demand as the e-commerce boom carried on. Its operating profit last financial year rose 15% to $1.2 billion, and its buildings had an impressive 98% occupancy rate. CEO Greg Goodman was upbeat about prospects yesterday, though its share price fell 2.3%. Meanwhile, Mirvac Group, which is much more weighted to residential units, said its profit jumped sharply on the back of 3,375 sales during the year. That's the highest since 2016. Its share price finished down 0.7% yesterday. It's been 4 years since Myer made a profit. It's been 11 years since its share price hit its peak, 7 times the current level. Yesterday, there was good news on both those fronts. The retailer said it expected to return to profitability during the current half year, sending its share price up more than 10%. The good news is on the back of rising sales, particularly online sales. GrainCorp has upgraded its earnings outlook for the 2021 financial year on the back of stronger demand for grain. It expects profit to be 40% higher than previous guidance. That is quite an upgrade, and its share price jumped 11% yesterday. In short, the 2021 financial year was a ripper for grain growers, while the current winter crop also looks pretty good. And Downer is a company that designs, builds and looks after assets in cities. They might be in transport or utilities or facilities. Yesterday, its share price jumped 4% after unveiling a rebound in profit despite a drop in revenue. Its urban services business was a particularly strong performer. Up next is our daily interview, and today I'm talking to Julie Lander, the CEO of Care Super. It's been a massive year for super funds. They've delivered some of the best returns on record for members, and the superannuation guarantee has risen to 10%. Also, the government's introduced major reforms to the industry, and there's a rush on to buy quality infrastructure assets. In short, plenty to talk about. And I cover it all with Julie. That's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. It's Friday, the 13th of August, 2021. I'm Sean Aylmer, and that was Fear and Greed. Enjoy your day.